Yeah, profitability is different. I mean, margins are only one input into profitability, Jeff. So if you look at ROE, it looks much less demanding generally. Certainly leverage has picked up, but asset turn is sort of looking more mediocre, I guess. So yeah, I mean, our case would be that there's certainly, you're seeing you should be seeing roughly the peak of profit margins, but that doesn't mean to say that profitability should take a sharp downturn lower. Yes, you're getting some fiscal steroids going through the economy. They haven't changed the trend growth rate of the economy materially, in our opinion. So yeah, your trend in earnings is lower than you're seeing in the second quarter, that's for certain. But I think generally, if you look at global stocks, valuations aren't that demanding in spite of kind of, some narrative out there. And really the thing to watch is the global economy about to come to a juddering halt? Now, obviously, humility is always appropriate here. There's all sorts of recessions can rain from clear blue skies, as they always say. But generally, if you look at the major indicators that we'd pay some attention to, from the yield curve to the ISM to various other metrics, they're not yet flashing amber. And so that suggests you've got to continue to invest, accordingly. The other point to make also is that valuations are almost immaterial with regards to tactical returns. They're important for strategic returns. So really, if you're looking at a long-term entry point, that's what you worry about valuation. So there may be some long-term headwind from sort of, reasonably elevated valuations in the US. But if you look at global stocks, this looks like a good entry point because you totally ignore recessions from from the strategic
standpoint. So what do I want to own? Just walk us through where you see opportunity at this point. I mean, Peter's talked a little bit about the prospect for a rebound in gems and how some of those parts of the market that have been beaten up by the stronger dollar may actually get something of a relief rally from here. I mean, just to be fair to Peter, he's been generally bearish, but tactically I think he sees the opportunity possibly through till 2020. Where do you see us putting money to make a decent return from here?
Well, I guess there should be, if you look at the sort of strong dollar effect, one of the sort of subsequent effects of the strong dollar is you inflate non-US profits a little bit, non-US earnings a little bit, so that may be something that helps coming forward. The other point to make is that the world ex-US does not look terrible. There's been some idiosyncratic stuff going on in Turkey, bad governance, various other places as well, but that doesn't look to be symptomatic of a wider emerging market malaise. The global trade story looks okay. Obviously it could get worse materially from here, but generally the prospects for growth, and again, the German IFO yesterday was another one saying that Europe seems to be finding a base somewhere. That suggests that earnings growth ex-US is going to be okay, and that's an area really which has been sort of obviously underperformed quite markedly. And if you look overall, since the beginning of the year, if you look at developed stocks, earnings expectations are up by 13%. In emerging equities, they're up about 2%. So you have seen a material derating across the board. So, if the world doesn't end tomorrow or the day after tomorrow or even, the month after tomorrow, then it probably means that you're going to see some catch-up from non-US equities. We'd keep some skin in the game with regards to US equities because you've got a quite helpful sector composition out there, but generally, yeah, there's the chance of a sort of bit of a value bounce elsewhere.